Welcome back to the deep dive. You gave us the sources, the research, and the notes, and today we're getting into something really crucial for, well, any serious entrepreneur or investor in South Africa.
We're talking about the South African Business Trust.
Exactly. And not just what it is, but how to use it strategically.
Yeah, this is a deep dive that's, I think, driven by necessity.
Yeah.
So many business owners, they see a trust as just another legal doc to sign.
Just a piece of paper?
Just a piece of paper.
Yeah.
But it's not. It's really the core architecture for long-term financial stability, for, peace of mind in what can be a pretty high-risk environment.
That's our mission today. We want to move beyond the textbook definition and really unpack this thing as a tool for asset protection, for generational continuity, and we're going to focus on what makes it actually work.
Which is often the hidden stuff, the strategy, the governance, and maybe most importantly, the people you put in charge.
Because the risk for South African business owners is very real, isn't it?
It's huge. We see it all the time. You have valuable assets, maybe the building your company operates from, or key trademarks, and they're sitting right in the operating company's name.
Or worse, in their personal name.
Or worse, in their personal name. Then you add personal sureties on top of that, where you personally guarantee the company's debt, and you've created a house of cards.
One bad lawsuit, one liquidation.
And it can wipe out everything you've ever built, personally.
Okay, so let's frame this whole strategy. The sources use a really powerful metaphor that I think helps a lot. They talked about building an asset protection fortress.
I love that metaphor because it's exactly right. That's how sophisticated wealth is structured. The fundamental idea is separating ownership from risk.
Okay, break that down.
So you strategically set up the trust to be the owner of the really valuable stuff, the property, the investments, the intellectual property. Meanwhile, your operating company, the entity that actually does business and carries all the day-to-day risk, you keep it lean.
So if the company hits some turbulence...
The fortress is untouched. It stands secure.
So for you, the business owner listening, what does this fortress structure actually achieve in a practical sense?
Well, it gives you multiple lines of defense. The most immediate one is shielding your personal assets, everything you've accumulated, from your business risks. If the company defaults, the creditors go after the company.
Not your home.
Not your home, not your savings. And that, leads directly to the other benefits.
Right, because your personal liability is suddenly much, much lower.
Dramatically lower. You're shielded from lawsuits. And crucially, you're laying the groundwork for smart long-term tax planning. We're talking about things like estate duty and capital gains tax.
And there's another benefit that I think is maybe the most underrated one.
Oh, continuity. Absolutely.
Yeah. Yes, continuity. If something happens to the founder in capacity or even death, a proper trust structure means the whole operation just keeps going.
The assets, the strategy, it all continues without interruption. It locks in that generational wealth that, everyone is trying to build.
So, to make sure we're all on the same page, let's quickly define the main types of trusts we're talking about here. They aren't all the same, are they?
Not at all. A trust is simply that legal setup where you transfer assets to trustees who then manage them for beneficiaries. But how they're created is key.
So you have living trusts.
Right, or inter vivos trusts. You set those up during your lifetime. Then you have testamentary trusts, which are created through your will and only come into existence after you pass away.
And for what we're discussing today, business, investment, continuity, we're really focused on that first one.
We are. The inter vivos, or business trust, is the workhorse. It's specifically designed for this kind of asset protection and succession planning.
Now, this is where the conversation gets really interesting, I think. We've built the fortress, the walls are up, but the sources were so clear on this point, the vulnerability is never the trust deed itself.
Never. It's always the governance. It's all about the people you appoint.
That's such a critical insight.
It is. A trust is not a safe deposit box you just lock and forget about. It's a living legal entity. And the people running it, the trustees, they are its backbone.
And they have a specific legal obligation, a fiduciary duty.
A fiduciary duty. And in plain English, that means they must, by law, put the beneficiary's best interest ahead of their own feelings or their own agenda. They have to act independently and prudently.
So this isn't a job for just anyone. You need to be incredibly selective. It's not just about finding someone you trust, but someone who is competent.
Especially if the trust owns a complex business. So best practice says you need a mix. You need personal trustees, maybe a family member who gets the vision, but crucially, you also need independent trustees.
And you have to avoid one person having total control. Why is that so dangerous?
The risk is that the trust gets declared a sham.
A sham trust, what does that mean?
It means SARs or creditors can argue that you never really gave up control, that you just treated the trust assets like your own personal piggy bank, paying your bills from the trust account, making all the decisions without any resolutions.
And if a court agrees?
The fortress wall comes down, the court disregards the trust entirely, and all those assets are suddenly exposed to risk again. It's why appointing at least one independent trustee is so vital. It proves that separation.
That makes perfect sense. The independence is the shield. And what about the executor of the will? They're separate from the trustees.
Yes, and that role is critical. The executor manages your whole estate when you pass away. If your will and your trust deed aren't aligned, you have chaos.
For example?
Imagine your will says your shares go to your child, but the trust owns the company. Or a shareholder agreement says your partner has to buy you out, but the trust says the shares must be held for a beneficiary.
It's a legal nightmare.
A massive, expensive dispute that can destroy the very value you were trying to protect.
Which brings us to the money, to the financial framework. If governance is the backbone, then tax strategy is the shield.
Yeah, and the tax rules here really force you to be strategic. The number one rule to understand is about income. If the trust earns income and keeps it,
Retains it, doesn't pay it out.
exactly,
Yep.
that income gets taxed at a flat, non-negotiable rate of 45%.
Wow, 45%. That is a serious penalty.
It's huge, and it's designed to be. It drives the core strategy, which is known as the conduit principle.
The conduit principle.
It means the trust should act like a funnel or a conduit. If you distribute the income to the beneficiaries in that same tax year, then the income is taxed in their hands at their personal tax rates.
Which would almost always be lower than 45%.
Almost always. It's just a much more efficient way to manage the cash flow.
Okay, that's clear. What about when the trust sells a major asset, like a property? What about capital gains tax, or CGT?
Right. For CGT, a trust has an effective tax rate of 36%. Now, if you, as an individual, sold that same property, your rate would be much lower, maybe around 18%, depending on your bracket.
So you pay more tax if the trust sells it.
You do. And that's the trade-off. It's a conscious choice. You're essentially paying a protection premium. You accept a higher CGT rate in exchange for the absolute security and protection that the fortress provides.
This all seems to come down to one word you mentioned earlier, alignment.
Absolutely.
The will, the trust deed, the shareholder agreements, the tax strategy, they all have to be singing from the exact same hymn sheet.
If they're not, the entire structure will fail the moment it comes under pressure. Conflict, death, incapacity, any of those things will expose the cracks. The strategy has to be holistic.
So we've painted this picture of incredible benefits, but also a lot of complexity. Governance risk, sham trusts, nuanced tax laws. This seems to scream for expert guidance.
Look, the concept of asset protection is simple, but as you can hear, the implementation, the compliance, the maintenance, it requires very specialized knowledge.
So this is where a dedicated trust consultant comes in.
It is. And it's not a luxury, it's really just operational due diligence.
Well, why is that so essential? I mean, if you're a successful business person, you've probably got a good accountant, a good lawyer.
They're brilliant at what they do. But a trust specialist lives at this specific intersection of fiduciary law, tax, and estate planning. They provide clear, actionable advice that's personalized to you.
They simplify it.
They offer simplified solutions. They break down the jargon so that you, the founder, actually feel empowered because you understand the why behind every decision. It's about removing the stress and uncertainty.
You mentioned maintenance before. Is this really an ongoing relationship, a fortress checkup?
It absolutely has to be. Annually, at a minimum.
Yeah.
You need to review risk exposure. Has your personal debt situation changed? How about the business? You need to ensure you're compliant with SARs, with CIPC.
And the paperwork.
And most importantly, you have to document annual trust resolutions. Without those formal signed resolutions every year, the trust starts to look neglected. And that feeds right back into that sham trust risk we talked about.
I think the biggest fear for any founder, though, is losing control. You build this thing, these precious assets, and now you have to put them in a trust where they're not technically yours anymore. How do you stay involved?
That's the number one concern, and it's a valid one. But you have to remember, you're separating ownership from risk. That doesn't mean you lose all influence.
So you can still guide the ship.
Absolutely. The founder can and often should remain a trustee, and you can build very specific, powerful rules into the trust deed itself about how assets are managed or distributed. A good consultant helps you find that perfect balance so the structure is legally robust,
Yeah.
but still reflects your vision.
Now, we should mention that the core principles we've been discussing today reflect the work of a dedicated professional in this space. Our source material was informed by the expertise of Lumka Sturman, a trust consultant and asset protection specialist.
And her work is really dedicated to this exact mission, empowering business owners to protect their wealth and secure their family's future with strong compliance structures. That fortress model is everything.
So let's bring this all home for you, the listener. The key takeaway here is that a South African business trust is a powerful strategic tool, but it is a living framework.
It is not a set and forget arrangement. Not at all.
Its power depends entirely on meticulous governance, on the integrity of the people you appoint, and on that absolute strategic alignment across all your
When
documents.
choosing those key players, the right trustees, the right executor, that's what protects your legacy. It
Right.
strengthens the governance and ensures the trust actually does its job and transfers value responsibly across generations.
Which brings us to our final provocative thought for you to consider. Knowing everything we've just discussed, the risks of misalignment, the danger of one person having total dominance, take a really honest look at your current structure. Would your structure survive conflict, incapacity, or death?
If that question makes you even a little bit uncomfortable, then now is the time to get a professional review. For anyone looking to build this asset protection fortress or just review an existing structure, you can learn more about this by visiting www.limcasterman.com.
Thank you for providing the sources for this really essential deep dive. We hope this knowledge empowers you to build a resilient and lasting legacy.